Hello, everyone. Welcome back to our channel. As we step further into an era where geopolitical tensions are more pronounced than ever, it's crucial for us, especially investors, to understand not just the risks, but also the opportunities that arise from such a climate. Today, we're going to explore the complexities of investing during these uncertain times and identify which sectors might not only withstand the geopolitical shocks, but could actually thrive because of them. From defense and cybersecurity to energy and commodities, certain industries offer unique opportunities for growth and stability when everything else seems unstable. Whether you're a seasoned investor or just starting out, grasping these dynamics is essential for protecting and potentially growing your portfolio in a world full of geopolitical upheavals. Segment 1. The new geopolitical alliances and their impact. The current geopolitical landscape is increasingly defined by the emergence of significant alliances and strategic realignments. On one side, we see countries like Russia, China, Iran, and North Korea forming what we might call the Eastern Bloc. These nations are strengthening ties, evident in their military cooperation, joint exercises, and economic partnerships aimed at countering Western influence and policies. Conversely, NATO countries, along with allies like Japan, South Korea, and Australia, are bolstering their commitment to mutual defense and strategic cooperation. This includes ramping up military spending and engaging in extensive diplomatic efforts to counter the Eastern Bloc's influence. Furthermore, countries in the global South are increasingly willing to challenge Western dominance. This shift is driven by a desire for more equitable economic development and frustration with global institutions that seem to disproportionately favor Western interests. The growing use of economic sanctions as a tool of dominance has undermined confidence in traditional global financial systems, prompting these nations to seek alternative transaction methods. Segment 2. Economic wars and investment strategies. Given the nuclear capabilities on both sides, direct military confrontation is less likely. Instead, we're witnessing a form of economic warfare. From the West, this has primarily taken the form of sanctions and restrictions in the form transfer of technology. They are also trying to cause collapse in China by moving manufacturing away from China to friendly allies and America. Although some of these investments are going into other Asian countries like India and Vietnam, most of this will go to America and Japan. America is at an advantage compared to Europe, as their energy costs are low. So most of the manufacturing that require oil or high-intensity energy will be reshored to America. From the East, efforts seem focused on destabilizing Western economies through means such as inflation and exploiting high levels of debt. Iran's proxy war by getting the Houthis to cause disruption at key trade routes in the Strait of Hormuz is aimed to get the energy prices up, as a lot of crude goes through the route. The aim is to cause inflation in the West. This will force the Federal Reserve to keep interest rates high. The problem here is that many households in Europe and UK have leveraged up on low-interest rate mortgages which are fixed for 3 to 5 years. When these are repriced, they will have to pay much higher mortgages, and a recession will cause a housing market crash. This will not be so much of a problem in US as most mortgages are fixed for 30 years. In light of these facts, certain companies are poised to benefit. American steelmakers and refiners are crucial as they are fundamental to both economic and defense capabilities. Again, if steel imports from China is banned, then they have a very distinct advantage. American chemical manufacturers stand to gain from a shift towards more domestically sourced materials and goods. This is due to low energy costs in the U.S. Investors should consider avoiding banks which may face collapses under economic duress, and European industrials which are vulnerable due to high energy costs. Segment 3. Disruptions in supply chains and energy. The potential blockades near pivotal points like the Suez Canal or the Strait of Hormuz could severely disrupt global shipping routes, leading to significant inflation. Companies that could weather this storm or benefit include mining and oil and gas stocks, which will likely see price increases as commodities become more precious. LNG shippers and general shipping companies will play critical roles if traditional supply lines are disrupted. Segment 4. Food security as a geopolitical tool. Food insecurity could potentially be weaponized. Western powers, with their abundant agricultural resources, might face challenges in terms of fertilizer and crop protection product availability due to targeted disruptions. Companies like potash and phosphate producers and crop protection companies such as Corteva and FMC are likely to be less affected and may see increased demand. Bayer presents a cautious option due to ongoing lawsuits despite its significant role in agriculture. Segment 5. The role of cyber warfare and drone technology in modern conflicts. As our dependence on digital infrastructure grows, so does the potential for cyber warfare. Companies involved in cloud services and cybersecurity, although currently overvalued, should be watched for future investment opportunities as prices adjust. In the realm of defense, drone technology companies like AeroVironment, Northrop Grumman, General Dynamics, and Raytheon are critical, given the increasing use of drones in warfare. Finally, gold will benefit from higher geopolitical tensions, and also the central banks are diversifying their holding into gold. So exposure to gold miners are good in our view. Our favorite stock is Barrick Gold. Newmont is another option. As we continue to monitor these developments, it's essential to stay alert to new opportunities that might arise in this shifting landscape. We encourage you to like, share, and subscribe to stay updated with our insights on how best to navigate these turbulent times in the investment world. Thank you for watching, and we'll see you in the next video.